worked with Sal now since last year, and we both have, come from the real estate business. I was a personal financial advisor out of college and got into real estate investing. I've been a realtor for 15 years and I've done a lot on the real estate investing side, and still do to this day. And I've been heavily involved in the financial education side, done a lot of financial seminars, and have traveled around the country, and built up a good client base and following across the country, and it's a lot of fun. So when I met Sal last year, with his background, I think you guys all know Sal on the real estate side, but Sal does a lot also on the financial planning side. And one thing that we both share in common is we both use something called the infinite banking concept, better known as, becoming your own bank, how to, be your own banker, as the hat says right here, BYOB.
I love that hat, Stephen. I want one.
Yeah, absolutely. Yeah. We actually just launched a store.
Cool.
And so when I was talking to Sal, he mentioned, hey, he has, a lot of, good relationships, fellow realtors, people in EXP, and different clients that could definitely benefit from, being the bank. And at the end of the day, becoming your own bank is really just strictly stopping the bleeding of all the interest to other people and allowing your money to compound and remain within your financial life for the rest of your life instead of it going away. And so what we've done is we've kind of created a little presentation here. Now, I do this presentation on stages all across the country. Typically, I spend 90 minutes doing it, but I can kind of get right to the root of it and the foundation of this. And we can do this pretty quickly today. Like I said, it's a smaller group, and I'm happy to kind of make it more interactive. So, while we get going here, if you guys have any questions or any comments, or just want to say, hey, Stephen, that's BS, like just call it out, like let's talk it through. So I'll get into this a little bit, Sal, but does that sound good to you?
Sounds great. Love it. Make it.
All right, cool.
Go ahead.
All right, so I'm not going to bore you guys with kind of the whole opening about the economy. I think if you're in real estate, you all understand what's going on right now. There's a lot of opportunities, especially if you've been in real estate before 2008. A lot of us saw, the big, huge boom we had and everything that happened with the crash. And I don't know you guys' opinions. I mean, I don't know if real estate's going to see that kind of crash again, but I think that we do have some opportunities ahead for people that know what they're doing. And I think we have some hard times ahead for people that are kind of just either ignoring it or not paying attention, put it that way. And so moving forward, to me right now, in my opinion, is one of the best times in our lifetime to get prepared for what's coming, because I truly believe that we're going to be able to take advantage of the markets as they come down and as things pull back and as things change. And outside of that opportunity, with what we currently have, like right now, it's so important, more important than ever in the past, at least the past decade, probably in my lifetime, to be prepared for it though. So where is our money right now? How can we take control of that money and not only not lose our money, so look at preservation of what we currently have, but be prepared to be able to grow wealth and really achieve our financial goals for retirement, set ourselves up for the future over the next several years. So that's where we're at right now, in my opinion. I don't know, Sal, what your thoughts are on that. If you want to add anything
sometimes,
to that.
Stephen, sometimes retirement could be a scary word or a very cloudy word without a lot of meaning. A lot of people are working through their retirement and may feel that they've run out of time to really look at retirement as an objective or a goal. But again, we're going to go back to why it's important to think in the now and start to take action today. That's all I wanted to add on that retirement thing.
Yeah, absolutely. It's all about control. So it's always, for me, always been about control, is, controlling wealth, controlling your life, controlling your future. If you're a realtor, a lot of that probably resonates with you. You got into real estate because you were tired of working for other people. You wanted to have time freedom. You wanted to be able to go out there and get out of what you put into something. And so those are people I love working with. The majority of our clients are business owners, realtors, investors. and people that kind of understand that aspect. I'm a big fan of people like Robert Kiyosaki, the cash flow quadrant. I got my start in the financial education industry shortly after learning about all this, traveling with Kiyosaki, speaking on stage with Kiyosaki, learning from Kiyosaki. So I'm a big fan of that whole idea, and it all boils down to control. So now doing this over the last 15 years, I've really found, if we look at what the Social Security Administration tells us, 5 out of 100 people at retirement age are going to retire financially secure, and not even financially successful, just financially secure. And that's a problem. I mean, we're the richest country the world has ever known. There's so much opportunity. So why do 95% of people not achieve their financial goals when it comes to retirement? Why does that happen? And, the 5%, those who I look to work for, as Sal said, he had 50 some people register for this. We have probably 5, 6, 7 people on here right now. So it always seems to boil down to that 5 to 10% are those that actually take action. And so why is that though? Like, where does that come from? So for me, it's really boiled down, why aren't more people successful? To these 3 wealth killers right here. So the mysteries of money. So why aren't more people? So when we look at what causes this throughout our lifetime, these are what I call wealth killers. These are where money gets bled out, money that we earn. So taxes, for example, if you look at just income tax, you probably pay anywhere from 20 to 30 to 40% of your total income to income tax, whether it's federal tax, state tax, local tax. And then on top of that, we have things like sales taxes, we have real estate taxes, home ownership tax, like all these different taxes and money going out. So this is stuff that we need to really look at. And so when I look at, all right, so if right now I'm bleeding out 40% of all the income that I make to taxes, well, what if I only bleed out 20%? Well, that'll give me an extra 20%. And that extra 20% that I now keep of my income, I'm not saying you should take that and go spend it, but what if we took that extra money and we started making that money work for us and having that money produce more money for us? Do you see how that could start exponentially compound throughout the years? So it's being smart about what we're doing. And there's lots of things we can do to save on taxes. We can create a side business, something like an LLC. We can start writing stuff off. We can be smart with even retirement dollars. So open up things like self-directed retirement accounts where we're taking advantage of tax laws, whether it's a traditional and getting the tax break today with the tax deferred growth, or a Roth where we pay the taxes today, but then it's all tax-free growth for the rest of our lives. And through self-directing a retirement account, we never give up control of our money. So we still control our wealth while taking advantage of all these different tax benefits that the government gives us. So just some examples right there. And what I'm teaching you today is a place to put your money and be able to get uninterrupted compounding tax-free growth on every dollar that you put into this new banking policy for the rest of your life. So you have tax-free growth there, and then we can use the money tax-free to generate even more income for ourselves. So I'll show you that here as we get going through this right now. So if we look at wealth killer number 2, inflation, inflation isn't usually something that's at the top of people's minds. But after the Fed printed trillions and trillions of dollars over the last 3 to 4 years, and the federal government has spent trillions and trillions and trillions of dollars over the last several years, it's caused inflation to skyrocket to levels that we haven't seen in my lifetime. I'm 40 years old now. And so last year, inflation was the highest it's ever been in my entire lifetime. So when I couple the last 2 years of inflation, the highest in my lifetime, plus over double where the Fed wants it today, 4 or 5% today, we're in double-digit inflation over the last couple of years. All inflation is an erosion of wealth and technically a tax on the middle class and the poor. It's not affected. The wealthy don't care about inflation. It doesn't affect them. Okay. I have my money moving all the time, compounding for me all the time. And that allows me not to worry about inflation. But for the normal everyday person, it's a huge problem. And again, it just goes out to, if I'm spending more money on goods and services just to live, I now have less money to put away and be able to towards retirement, or money that I can grow my wealth for something in the future, for my family, for people that are important to me. So inflation's a huge problem. So how do we start eliminating inflation from our lives? Well, one of the ways is what I'm going to show you today, things like compounding returns and always having your money moving, making more money for you. So we'll talk about that. And then volatility. Volatility is in front of everyone right now. What do I mean by volatility? Well, that's the stock market is a perfect example. The stock market, up like crazy, COVID down like crazy, all the pumping of the money back up like crazy. We're back up to all-time highs right now. When you couple that in with everything else going on in the economy, I wouldn't be surprised to see the markets take a 10, 20, 30% dip this year, maybe more going into 2024. Even if we just lose 20%, did you know if something goes down 20%, it takes 30% gain just to get back to equal? It's called, when you look at like actual versus average returns, that's where we start talking about where this effect takes place. If I lose 30%, I got to make 50% back just to get even. And so volatility will erode our wealth. It'll kill our wealth, playing that out. And where it's even more important is if you're coming up to retirement age and you've been saving in a 401k in the stock markets and everything's looking good, you're on track and your plan is taking place and you're ready to retire. Well, what if the market does crash all of a sudden and your money comes down along with that? And even if you just moved it into cash, you're like, listen, I'm out of the markets, I'm in cash. Well, that double-digit inflation is killing your wealth right now. So it's like, where do we go to get these returns? So this is where we got to start being smart. We got to start understanding there's alternative investments. And that's why what I'm teaching you right now, coupled with something like real estate, passive real estate through private money lending, taking advantage of private funds, becomes so powerful. And so I'll show you those examples today where instead of riding this up and down volatility, where we can get consistent, predictable returns for the rest of our lives, even through retirement. And so that's what this is all about, is just eliminating these wealth killers. And I'm sure there's more, but just from the last 15 years of doing this myself and learning from clients, these are really the three that I can teach you right now that you can start implementing right now and start eliminating those from your lives. Now, the other three kind of mysteries of money and wealth killers are more on the mindset side. So this is kind of more on you. And what I mean by that is, one, I could teach you, Sal could teach you, Warren Buffett could teach you everything you need to know to become very wealthy. But guess what? If you don't apply that knowledge, nothing will ever happen. And so things like fear end up holding people back. The not understanding what's next, not fully understanding what a process looks like. And that's why we kind of boil this down very simple and say, listen, let's take this very slowly, step by step. But I promise you, if you take that first step, you will be able to climb that ladder, climb that mountain and get to where you want to be. But it takes that first step. So we got to get past our fears. And a lot of times that fear comes from the people that we love in life. So like family, following the status quo, like doing what's always been done. And a great example of that is a 401k. You know, when you start a job, everyone tells you, go put your money in a 401k, put as much as you can, max that thing out. Well, why? Why? I get that you're going to get a little break. Maybe you're going to get a company match. I'm okay with that. But why would you ever give up control of your money? Even at even at 40 years old today, I start putting money in a 401k. I give up control of that money until I either leave that job or I turn 60 years old and I can start withdrawing it. And yeah, sure, it's tax deferred growth in there, but when we're $32 trillion in debt as a country and we're spending like there's no tomorrow, how are we going to pay for that? Eventually, taxes are going to have to go up. So if taxes are going to go up in the next 20 years and deferring paying taxes until that point, like where am I going with this? And so things like that. And then we have, of course, the volatility by giving up control in a 401k. So just following what's always been done just because is a real problem. And so it takes hopping on webinars like this. It takes finding a mentor. It takes reading books and educating yourself with alternative investments and techniques and strategies to really get you to where you want to be. And that's exactly what I do all day, every day. So what I do is I work with a business partner. His name is Chris Nagle. And we have something called the Money School, BYOB Money School. And this is all we teach, is how to take back control of your money and solve your money. And we use strategies like what I'm teaching you right now with the infinite banking concept and becoming your own bank. We teach you things like self-directed accounts. We teach you things like private money lending and real estate investing and how to really control it. And one of the reasons I love Chris and why I leave this picture up on the screen right here when I introduce him is this quote right here. It's never about your actual resources. It's about how resourceful you can be. And if you relate that back to real estate, for an example, there's so many people that are like, I'd love to get into real estate. I just don't have the money. Well, that's not an excuse. Because, for example, we run a company called Private Money Club, where if you can produce a deal, you can produce something that's going to make money. There will be somebody that's there that is willing to lend you money on that deal. The money is an excuse. It's not a legitimate reason to not be successful if you know what you're doing. Retirement accounts, there's billions, well, there's trillions of dollars in retirement accounts in this country. There's billions of retirement accounts out there. Less than 4% of them are self-directed. So 96% of people are just blindly letting an advisor or throwing their money in indexes or mutual funds in the stock market. Less than 4% of money, they're actually controlling their retirement. So what if you learn how that's done and you go start educating people on how they can lend you money? Say, hey, Sal, I have this deal. I need $100,000. The property's worth $200,000. You give me 100 grand, I'm going to pay you 12% returns for lending me the money, and I'm going to pay you back within 6 months. And your 100 grand is going to be secured by a $200,000 property, just like the banks do with a mortgage or a deed of trust. You know, are you willing to do that? Well, you're like, well, I don't have 100 grand. Well, Sal, do you have any money in the stock market right now? Yeah. Is that in an IRA? Well, yeah, actually it is. Well, are you worried about the stock market coming down and pulling back and maybe going into a recession and crashing? Yeah, that's one of my worries right now is I'm going to lose my money. Well, why don't, instead of you riding that risk and the volatility in the market, why don't you lend me your money from your IRA? Well, I can't do that. Fidelity doesn't let me do that. Morgan Stanley doesn't let me do that. Well, yes, you can. You just have to move it to what's called a self-directed custodian, where now you have control of that retirement account. There's no taxes. There's no penalties for doing anything like that. You're just moving it from one brokerage to another. That's it. But now that brokerage allows Sal to lend money to me on a real estate backed deal. Now he's grown his money at 12% instead of riding the volatility of the stock market. So things like that, you just have to be educated on it. So that's my only point. And that's why I love that quote right there. So that's exactly what we teach. So I just want to give you guys some resources real fast. If you're taking notes, maybe write some of this stuff down. So a couple books I would highly recommend that are going to reinforce what we're teaching you here today. A book called Second Chance by Robert Kiyosaki. A book called Money Master the Game by Tony Robbins. He talks all about the infinite banking concept in chapter, I think it's 4 or 5 of this book. I always forget which one of those, 4 or 5. I'd have to look, but we'll do it later. Becoming Your Own Banker. This would be probably the #1 book that I would recommend picking up by a guy named R. Nelson Nash. This will completely change your mindset on everything you've ever learned about money. I promise you. This is an updated version by my 2 business partners, Brent Kessler and Chris Nagle. And then another book called The Private Money Guide, Real Estate Edition by Chris. So what I'm going to do for everyone on this call right now is I'm going to give you guys these 2 books, as well as a third one, completely free of charge just for being here. So I'll send you digital copies of these books to get you started on this financial journey. But when I go back to those, wealth killers and the mindset part, books, podcasts, webinars, it's just so important. So please start with these books, and I'll send you the digital copies that you guys can read. I'll show you how to do that here in a few minutes. All right. So I live near Sal, about 45 minutes away from Sal, over on the east coast of Florida in the northern Palm Beach County area. Like I said, I've been investing in running businesses for 15 years now, primarily in the real estate investment and financial education spaces, although I have had some other companies as well over the years. I've now helped over the last 4 years, over 1,000 people start these banking policies and become their own banks in all 50 states. Just so a little bit more recently. So just a little bit about myself. All right, so let's dig into this a little bit. All right, so I want to start with a quick question for everybody that's on here right now. And Sal, maybe you can kind of watch the chat box. But let me just ask you guys a quick question here. So how many of you think you can make money earning 4% on your money while it paying 6% on that money? Put yes or no in the chat box. Can you make money earning 4% while paying 6%? What do you think?
Oh, we have 2 no's. All right. Anyone else want to come in on that?
All right, so we got a couple no's coming in. While they're responding, I'll kind of show you an example here. Right. So again, this just goes back to mindset, just kind of changing, like, hey, there's possibilities out there that I never knew existed. All right. So let me show you how this works. And what I teach you with Becoming Your Own Bank today, all we're going to do is mimic what banks do. And this is exactly what banks do. This is how banks operate. And this is one of the ways that banks make money. So I'll show you several ways today that banks make money and how we're going to mimic the exact same thing by becoming our own bank. So if you were to go let me give you an example. So if you were to go get a car loan today. All right. So let's just say over the last, several years, you've been saving up to buy a car. And let's just say it's a $25,000 car. Now, I have another business partner named Devin Burr. Awesome guy. Go follow him on Instagram. If you guys are on Instagram, it's Mr. MR_Burr, BRRRR. Really cool. But so he just did this exact same scenario with a new Audi R10 that was $250,000. So if you want a more expensive car, just add a zero or change the numbers. This concept still works. All right. So let's just, for this example, let's say you've been saving up money for the last few years to buy a new car. So you've saved $25,000. So you go down to the bank and you say, hey, Mr. Banker, I would like to withdraw $25,000 from the teller. So first off, the teller is going to say, whoa, hold on, let me go get my manager. Because the bank probably doesn't even have $25,000 cash sitting there, which is a huge problem in its own right. But also they're going to ask you all kinds of questions for withdrawing your own money from their bank, which is another big problem, in my opinion. They're going to say it's for money laundering, but anyway, you're giving up control when you put your money in other people's banks. Keep that in mind. So, but just say this happens. So a manager is going to come over to you and they're going to say, all right, well, why do you want it? Well, I'm going to buy a new car with it. And the manager is going to say, all right, well, listen, what if I make a deal with you? What I'm going to do is I'm going to allow you to keep your money, $25,000 in your savings account. And I'm going to give you a magic savings account because I'm going to give you 4% annual return in that savings account. And what we're going to do is we're going to use that savings account as collateral, and we're going to give you a loan so you can go buy that vehicle. And you say, okay, well, that's cool because I was earning 0.04% before, and now I'm going to earn 4% on my money. So that sounds good. Let's do it. And you say, well, actually, hold on first. Like, what is the loan? You said you're going to give me a loan to buy the car. So how much is that loan going to cost me? And the banker says, well, we're going to give you a loan at 6% annual interest to go buy the car. And you say to the banker, whoa, 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 hold on a second. So you're going to pay me 4% and I'm going to pay you 6%. I'm not going to do that. I'm smarter than that. How many of you agree with that? Keith, Teresa, John, and Lori all would have argued with the banker there, right? But let me show you how this actually works. And Joe's laughing a little bit, so he might know where I'm going with this. I see him on the screen. So here we go. So here's how this actually works, right? So let's encapsulate this out. So how does a car note work? Well, you take the initial loan, and then what happens each month? You make a payment on that car note. So in this scenario, over a 5-year car note, you're going to make, and you guys can do the math on this, at 6%, it's $483 a month that you're paying on that car note. Well, each time that you pay that $483 a month, what is happening with that balance, that $25,000 balance? It's decreasing each month, right? So each year, as you pay this thing down, that balance is going to be less and less and less. So at the end of the 5 years, you will have paid about $4,000 in interest, and the future value for the bank will be $29,000. Well, what happens with our money sitting over in our savings account at the bank? Well, that money is going to compound over the next 5 years, meaning that 25,000 the first year grows by 4%. Let's say that's 26 grand. So then the second year, now the 4% is growing on the 26,000, not the 25. So now the second year, that 26 might grow to be 27.5. And in the third year, maybe that grows to be 29. So that's going to be increasing each year over that same 5-year time span, to the point of, after the end of the 5 years at 4%, that 25 grand grew to be just over $30,500. So if we would have listened to the banker and grew our money at 4% while paying them 6% for that money, we would have actually just made over $1,500 on our money over that 5-year time span. Does that make sense, everybody? Because on one side, we have simple depreciating money that we're paying, simple interest we're paying. On the other side, with the 4%, we have compounding, uninterrupted compounding returns going on. So as I go here today, just keep that in mind as we talk about how the banks work and how your new banking system is going to operate in your financial lives. Fair enough with everybody? Does that make sense?
All right. Sounds great, Stephen.
All right. So how does all this work? All right. So what is the money multiplier method? What is infinite banking concept? So what we've done to show you this is we've broken it down into 3 individual sections. Okay. And that's what I'm going to show you here today. So first off, we have the machine. So this is the vehicle that this banking policy, this new banking system is built upon. Number 2, we have the marathon. So this system will 100% be able to start helping you in your financial life, and you'll be able to start taking advantage of it immediately. This is not something you're putting money away for years and years and years and waiting on. But let me say this is also not a get rich quick scheme. Okay. This does take some time. And I just want to make that very, very clear to really see the true mind blowing benefits of it. But if you're willing to put a little bit of time and run this marathon with me, I promise you it'll be life changing. And like I said at the beginning, when we're overcoming fear, a lot of times it becomes that first step. This is just like that, where you have to teach a baby to crawl, to sit up, then to crawl, then to take its first steps, then it can start running, and then you're off doing marathons. But you have to follow this process. So I want to be very clear here. I'm going to show you what the machine is. The machine is not as important as what the process is. And that's what that marathon. So I'm going to show you that here right now. But if you follow these two, if you use this machine and you do this marathon, then this is where this becomes fun, because now we can talk about the millionaire. And that's always everyone's favorite topic, is how do I use this to create true financial success in my life and for my family? And so I'll show you exactly how we do that right now also. All right. So let's start with the machine. What is this machine? All right. So this machine that we're going to use, this vehicle we're going to use, is what we call a dividend paying whole life insurance policy from a mutually owned insurance company. Okay. Now, let me just make a couple comments on this first off. When I was a financial advisor, I was fully licensed, Series 7, 66, 215 life insurance. When I quit that and became an entrepreneur, business owner, and real estate investor, I let all my licenses go. I said, I'm never going to go back to being a licensed advisor, so I have no reason to keep those things. And they were hard to earn, okay? But I decided to let them go and never go back. Never in my wildest dreams did I think in 2020 that I would get relicensed in insurance. Okay. Now, why did I have to get relicensed in insurance? Because it's the only way I can legally create this banking system for you. Now, why do we use a life insurance policy to do this? You tell me. And I'm going to put it on you guys real fast. If I was to ask you what the perfect investment looked like, what would the perfect investment look like to you? Please put it in the chat box. Or if you want to come on the microphone, just say it out loud. What would the perfect investment look like? Just put some things.
All right. Well, the perfect investment would have great upside potential.
Okay. Like I said, we have a smaller group, so I just want to kind of get a little more active. So what would a perfect investment look like for you guys? Go ahead, Joe.
Definitely real estate that has ability to add on to it, like fix it up.
Flexibility.
Yeah, that's good. Thanks.
Okay. Okay. I see what you're saying, like being able to force appreciation or force growth, I guess. Appreciation. Yeah.
Yeah.
Okay. So really, real estate appreciates. And when we do a fix up, like a flip, for instance, we're just forcing more appreciation, really. So appreciation. Okay. So here we go. We got some stuff coming in. So access to profits anytime with no penalty. Love it. Earning interest and money is protected. Okay. So it's earning and the money's protected. And then, okay. So it pays out at a higher level than what you put into it. Okay. All right. And I didn't necessarily want this to be based on insurance, but I see what you're saying, Teresa. All right. And the reason I ask this question is because what a whole life policy will do for you is it's guaranteed growth, a whole life insurance policy. Now, let me make this also clear. We're not talking about like an IUL or a VUL or any of these crazy products out there. I'm talking about a simple whole life insurance policy from a mutually owned insurance company. Now, this whole life policy that we use, let me also make this clear. This is not something you go to somebody in your networking group or your buddy that sold insurance for years or your high school friend or your brother-in-law. We take a whole life insurance policy and we literally hack it up and we turn it into something that you would never recognize. And by doing so, Sal and I give up 60 to 90% of the commission that we would typically make on that whole life policy. So first off, understand we make a huge reduced commission to give you all the benefits and advantages to having that policy. Okay. So that's one thing. So if you take a typical insurance agent and say, hey, will you do this for me? Or why aren't you selling whole life this way? They're not going to give up 80% of their income. They're just not, but this is what we do. So this is what Sal and I do. This is what the money multiplier does all day, every day. This is all we do. I sell one product, a specially designed whole life insurance policy. You want something else, go to somebody else. Okay. So that's plain and simple. So I just wanted to make that clear. And we use a whole life because the United States government gives us the laws and the ability to use this thing this way. Okay. That's the only reason. They do it themselves. So these laws aren't going to change. They actually just changed the laws a couple of years ago, something called, look this up, IRS Rule 7702, and they made all these changes. Guess what? They made whole life policies better for what we do. They allow us to put more money in now with less stuff benefit without necking them. So it's really cool. But what a whole life policy does when it's designed the right way, it gives you access to your capital anytime. You can use it anytime while the money sits in there and compounding. You get compounding uninterrupted returns for every dollar that goes into it for the rest of your life. It's guaranteed growth. And as an advisor, you guys know you cannot say guaranteed in anything. This is the only product I've ever sold that I can say it is guaranteed. It's tax-free. Most people, when they say, what's your perfect investment? It's tax-free. This is tax-free. And then, Joe, you want to use it for real estate. You take this money from your policy and you use it in real estate deals. You put it into it. You grow your money over here while it's over here compounding and growing for you. So that's why we use a whole life policy. If anybody ever finds another vehicle that provides all of those advantages, I'm happy to give up my life insurance license and go use that vehicle instead. Trust me. It doesn't exist. So I just wanted to make that stuff clear. Is that fair enough, Sal? We good?
I'm going to add one other thing to it, and that is that, and this is really important, and that is that it flies under the radar screen. Okay, and that's critical, especially if you want to keep it away from Big Brother, in a way.
Yeah, absolutely. The money's protected. You don't have to report this anywhere. It's hidden from bankruptcies and lawsuits. People can't touch it. I think the veil has been broken one time in California on a weird case, but it's typically 99.999% of the time it's completely protected. I think somebody said that over there. My money's protected, and you're absolutely right, Sal. And one of the big reasons for that is I truly believe is because the politicians do it. They all use these things. I mean, they're becoming. They've been around for hundreds of years, but they're becoming a lot more popular. People like a lot of companies right now and different corporations are using this type of policy as a way to compensate high level executives and business leaders. A great example of this a few years ago, Jim Harbaugh, any football fans, Michigan's football coach, a large portion, he became the highest paid football coach, and a large portion of that came through deferred compensation using whole life insurance, right here, cash value life insurance policies. So we're seeing a lot of that right now. Like I said, a lot of politicians, Biden's got 6 of these things. Walt Disney used it back in the day when he was running out of money to fund Disney World. He tapped into his whole life and started using that to keep things going. Doris Christopher used her whole life policies to start Pampered Chef. And I think all you guys might have heard about, that was sold to Buffett for $700 million years later. Ray Kroc with McDonald's. And it's been used by the JPs, the Morgans, Chases, Vanderbilts throughout history. So what we're teaching is nothing new. I like to take a little bit of credit that we put a nice spin on it to teach it to people. I talk to people all the time that are like, I heard about this concept years ago, but the way that you taught it made a lot of sense, and it kind of brought it, back to reality for me. And so, but this is something that's not new, and it's used for hundreds of years, and it's not going anywhere. Like I said, they just made the laws actually better for us being able to do these. All right. So let's get into this a little bit. Any questions on any of that? I don't see anything coming in. All right. And again, if you guys have any questions, put in the chat. I'll stop. We'll talk through it, or just interrupt me, but I'll keep rolling otherwise. All right. So when it comes to, how money, how this system works, what we need to start understanding. So one second, guys. Just let me shut this. Anybody else live in South Florida? We have it looks like the afternoon thunderstorms are hitting right now because it just got super dark outside, and my dog gets a little crazy when it gets windy.
And about 45 minutes south, it's perfectly clear.
There, South Florida, right?
Yep.
Exactly. So, anyways, all right. The good news is, even if we lose power, I got battery backup systems on my office system and my whole Wi-Fi network, so I keep going. All right. All right. So to understand how the system works, we got to understand how money flows and how we're going to stop bleeding all this money out to other people. And this is a real simple example that makes a lot of sense. So if we take a dollar bill, for every dollar that you earn, on average, and again, these are averages, so it might vary a little bit, but on average, 20% of every dollar that you earn goes to an automobile. 30 cents of every dollar that you earn goes to housing. 40 cents of every dollar that you earn goes to everything else: kids, college expenses, travel, taxes, everything else, which leaves the average person with 10 cents of every dollar they earn goes to saving at the end of the day. Now, that number is dropping right now. During COVID, it rose. Right now, it's dropping. Credit usage is hitting all-time highs because savings are gone. And so we're starting to see that change a little bit. But on average, this is kind of what that looks like. All right. So let me show you what we can start doing. And the reason why this happens is because people make money. It goes out to everybody else. And then what's left over, they consider their savings. Well, what if we did this different? What if we did this backwards, so to say? So let's see what that would look like. So what if we took that 10 cents right off the top and paid ourselves? We put that into our banking system first before paying everybody else. And then we start paying everybody else. Well, on average, that 20 cents that goes to an automobile, 5 cents of the 20 cents goes to interest on average. So of that 5 cents, instead of giving that to BMW or Toyota or Ally Financial or one of these car finance companies, what if we paid that 5 cents to our banking system? So let's do that. Okay. So by doing that one move right there, paying ourselves and then financing the automobile with our bank instead of somebody else's bank, we just were able to increase our annual savings by 50%. Because think about it. If prior, the old way, we were saving 10 cents, and now just by paying ourselves first, we're now able to pay ourselves an extra 5 cents annually. So 15 cents instead of 10, we increase 50%. That one thing right there, just by paying ourselves first. And I'll show you exactly how that works in the next example that I have coming up. All right. But what if we do this for other stuff? What if we do this for housing? So in housing, did you know of every 30 cents that's spent on housing, 25 of that 30 cents goes to interest? Well, why so high? You all are in real estate. You should know this. The due on sale clause. On average in this country, people move or refinance every 7 years. If you look at an amortization schedule, 80 to 95% of the interest goes to the bank in the first 7 to 10 years. So if people are moving regularly every 7 to 10 years, and the banks are getting 80, 90% of their interest every 7 to 10 years, do you see why they entice you to move? Why they do teaser rates, why they encourage refinances and all the rest of it, and why that due on sale clause exists? Because they don't care. They get their money up front. They have you move on, and then they start the process over again. So that's why so much. So what if we start buying real estate with our own banking system and recapturing all that interest into our financial lives instead of everybody else, instead of into somebody else's bank? And then while we're at it, on average, 5 cents of 40 cents that goes to everything else goes to interest. So let's just go ahead and recapture that 5 cents as well. So by doing nothing different except paying ourselves first and becoming the bank, we now are able to save on average 45% a year as opposed to just 10 cents. We work no harder, we work no longer, we took on no more risk, and we just created a lot more savings each year for us. Now, by having additional money each year, now what we can do with that additional money, we can send that money out there into the world with smart investments to make more money for us. And when you start compounding your money that way, it's amazing how your net worth starts to increase very, very quickly. Okay. And again, I'll show you exactly how this works. All right. My electricity is flashing a little bit, just so you guys know. We'll keep rolling here. All right. So how do banks do this? I showed you an example before of how they kind of move money and how they do loans and they make this. So this just kind of drives it home. Banks work off what they call a spread. So you make $100, you go down to the bank, you deposit at the bank. Again, let's say this is a magical bank account. They pay you 4% in your savings account. Well, you guys all know the bank doesn't just have the money sit there at the bank. The bank immediately takes your money, and what do they do with it? They send it out there in the world to make more money. And that's exactly what they do. So they pay you 4% and then they give somebody else a home loan at 7%. The homeowner takes that property, they give it to the seller. The seller now has that money. What does the seller do? They put it right back in the bank. And this happens for everything in our lives: car notes, home remodel loans, debt consolidation loans. But it's the same thing over and over. The bank's using your money to lend it out and make money. So what are they doing? They're making a spread. So they're making 3% off that mortgage. They're making 4% off that car note. They're making a spread. So at the end of the day, they paid you 4% in your savings account. And if I just add all this up, they just made 20% off your money. So they made 16% off your money. But in reality, it's actually a lot more than that. Because if the bank made 20, you made 4, that's a 500% return. They just made 500%, 5 times what they're paying you, 500% off the money you're leaving sitting at that bank. And you don't have to take my word for this. So I'm going to give you some more homework. Go to BauerFinancial.com. And this is a website, a research company. And all they do is research banks, bank financials, how banks operate, what banks are doing with their money. And they tell us that banks make between 400 and 1,300% off money that you leave sitting there. So my question to everybody on here is, why are you making the banks rich instead of making yourselves and your families rich? If the banks are making 400 to 1,300% off your money sitting there, why aren't you making 400 to 1,300% money off the money you're putting into your bank accounts? And that in its essence,
I'd love to hear that answer.
Yep. Yeah. I mean, that in its essence, Sal, is what BYOB is all about, becoming the bank. This is why you want to be your own bank. And John was saying, yes, Ben. Oh yeah, so John's over in Venice. So all right, so let's keep rolling with this, but I just wanted to kind of show you the importance of how this works and what this looks like. And this is why banks, do you guys know where banks put their money? I skipped over this before. But when I showed you this right here, banks, did you know banks are the largest purchasers of whole life insurance in the country? So banks, 92% of banks' money supply goes to 2 places. M1 money supply goes to 2 places. It goes to whole life insurance policies and it goes to real estate. That's where banks put over 92% of their M1 money supply. If you think about it, where are banks located? In the most beautiful, in every city across the country, some of the most beautiful skyscrapers and buildings. What is the name at the top of that bank or at the top of that building? It's a bank. It's a financial institution. If you drive down the road in any suburban, rural, urban area around, every corner has what on it? A bank. These banks are buying this real estate. They're buying it up all over the place. This is where they put their money. So if banks are putting their money into whole life insurance policies and real estate, does it make sense that maybe we start mimicking what they're doing? Banks typically know what they're doing. Now, the Federal Reserve absolutely crushed the banks with what they've done with all this silliness with the rate hikes and some of the stuff that they've been doing, which I'm not going to get into right now, but so it's caused some of these bank failures, and that kind of couples with some of the investments these banks, some of these more risky Silicon Valley type banks were making. But nonetheless, typically speaking, historically speaking, banks are very good at what they do. And so we're just going to mimic that. All right. So what I'm going to do now is I'm going to show you a few examples exactly how this can work. All right. So I'm going to give you 3 different examples right now. Number 1, I'm going to show you how you can get back every dollar for every car you'll ever buy, drive, and own in the future. And this will relate to any purchases, not just cars. But how many of you would like to get that? Every car you buy from now on, you get back every single dollar for that car for the rest of your life. Number 2, if any of you have any debts, I'm going to show you how to pay off those debts a lot faster than otherwise possible while still building wealth. Not just giving all your money to your debt companies, but actually building wealth in the process. And number 3, how to use this in real estate, both passive and active, to make money multiple ways and start really compounding our wealth creation. All right. So let's dive into this a little bit. So let's take a quick look. And while I show you these examples, I'm actually going to start teaching you also how to start using this system and what it looks like to be your own bank and use the infinite banking concept. All right, so this is actually what we call a policy illustration would look like. So when you start one of these policies with us, we're going to design a policy for you. And I'm going to show you a bunch of examples coming up. So here's one of those examples. So over on the left side, we have the year of the policy. We have the age of the individual. We have the amount of money that's going into the policy, which I'll talk about in a second. And then this all has to do with buying a car. I'll get to in a moment. All right. So number one, when we look at this illustration, the money going into the policy each year are technically the policy premiums. But a lot of this is mindset, right? I talked about that before. So I want you to start thinking about the money going into this whole life policy as a deposit. Now, why would we make that one little change right there? It's all mindset. Because when you pay your car insurance, your health insurance, your homeowner's insurance, that is a premium. And we think of that as a negative. That's something, oh, that's an expense. That's something that I have to pay, right? But if you go out and you make $30,000 commission on a nice real estate transaction, you get that check from your broker or from the closing agent, and you're excited to take that $30,000 check and go deposit it into your business account, right? You're like, hell yeah, I just made money. So if you made that 30,000, why would you not be excited about going and depositing it into your new banking system, even though it's a whole life policy? So do you see why we kind of make that mental shift right there? I really want you to start looking at this as a banking system. So that's one thing right there. That I want all of you to commit to changing that one little thing right there. Number two, age doesn't matter. So we do policies for 6-week-old babies, teenagers, people in their 20s, 30s, 40s, 50s, 60s, even into their 70s.
Yeah, like I said, I did this. We worked on a 76-year-old. He said, I really want to do this. Can I do this? The answer was absolutely.
Exactly. So that doesn't matter. And even those of you that are like, well, I know I have terrible health. I know I can't qualify for a whole life policy. We have answers for that. We can use a business partner, a spouse, a child, somebody else in your life. We can use their life for this and still allow you to own it and control it and be your own bank. So we do have solutions for that. So keep that in mind. The amount of money that you put into this is also completely up to you. We can talk through that with you. What we recommend is 10 times your age on a monthly basis. It's kind of like a guideline, kind of, that amount or more is kind of like a getting started spot. So me at 40 years old, if I was putting like $400 a month in, $5,000 a year in, that'd be like a good starting point. Like, can I at least do that? Or, more 10,000, 20, whatever that is, but you decide. And I'll show you some examples as we go through with that today as well. And then the death benefit on here. So the death benefit, I think somebody mentioned that before. When I put money into the policy, into something, it'd be nice if that later pays out at a higher amount. Well, this death benefit, as money goes into this, is always also going to grow for the rest of your life. So, and that death benefit does get paid out tax-free. We're not building this for the tax benefit, but is that okay if your loved ones receive a nice big tax-free cash, what do you call it, windfall upon your passing? And guess what? If you don't want them to get that, put it in, have that money go into a trust that you control from the grave. So I can talk to you about things like different types of trusts that help with estate planning also. But nonetheless, I just wanted to point out some things on kind of what this illustration policy looks like. All right, so let's get into this. All right, so for this example, I have the same policy, and this young guy, he wanted to buy a car in the 3rd year of having this policy. And again, we're just going to use a nice, even $25,000 car. So he starts putting money into this policy. What's known as the cash value starts growing in this policy, this banking system. And the 3rd year, he decides to take money out of the policy to go buy a car. All right. So just like if we were to go to somebody else's bank, Toyota, for example, or Ally Financial, and borrow $25,000, we're going to pay back Ally Financial. So what we're going to show you when you're your own bank is how to be what we call a honest banker. So you're going to pay yourself back just like you would pay somebody else's bank back. So that's what you see right here, the bank the car loan payment. So let's just say I think when we did it before at a 6% loan, it was $483 a month. So let's say this is a 6.2% loan, $500 a month. You're going to recapture back $6,000 a year coming back into the policy. So what does this look like? We just deposited $70,000 over 7 years into our banking system. We took $25,000 out to buy a car. We recaptured $30,000 over those 5 years that would have went to somebody else's bank that now came to our bank. So at the end, we net injected $75,000 into this banking system. Okay. So we put 75,000 in. We have $67,881 available in our banking system. And we have a $25,000 car free and clear sitting in our driveway that we can sell, that we can keep, that we can do whatever we want with. Now, at the end of the day, over those 7 years and that car purchase, I just recaptured 91% or 91 cents of every dollar I used to buy that car. Okay. And the way I have that is I put 75,000 in and I have 67,000 available. So 91%. Now, I told you a second ago, though, I'd show you how to recapture 100% of all the money that I put into this thing. So let me show you that, because this does not stop after 7 years. This keeps going for the rest of your life. So let's look at the next 5 years, what that would look like. Now, for the sake of argument here, and to show you this example, in the 8th year, we're going to stop putting money into this policy. Now, in reality, you'll continue to put money in, and you'll see why in a second, because each year, the amount you have available is exponentially stronger. So you're going to want to put more money in, not no money or less money. But nonetheless, let me just, for this example, show you. So in the 8th year, we decide to buy another car. So we buy that car, $25,000. We're an honest banker, so we recapture the money. So we put no new deposits in. We put a net injection of 5,000 in once you do the purchase and the recaptured money. And we have $91,473 sitting in our account. All right. So we put $5,000 in. We recaptured $5,000. But look what happened. Our account grew from 67,881 over those 5 years to 91,473. We put no new money in, and all we do is recapture the interest of $5,000 to get that. Why? Because that money that you put into the policy is going to compound and grow for the rest of your life. So that's why this thing never stops growing, even when we're not putting any more money into it. So we just bought 2 vehicles for $50,000. Sitting in our driveway free and clear. We have $91,000 sitting in our account, and we put a net injection of $80,000 into this thing. So we've just recaptured not only every single dollar for those 2 vehicles, but we now have even more money than we ever put into this system. Fair enough? So now to make this happen, there's 3 rules that we had to follow. All right. And if you were following earlier, you're going to know these 3 rules. Rule number 1, pay yourself first. So remember before, I said we're going to pay ourselves first to start this banking system, and then we're going to start financing these things from our banking system instead of somebody else's. Rule number 2, always pay ourselves with interest. And rule number 3, always recapture and recycle our money. All right. So what do I mean by that? Pay ourselves first. Like I said, we're going to pay ourselves into our banking system. Number 2, pay yourself with interest. So being an honest banker, we're going to want to treat our money like the bank's money. Meaning, if I go buy a car today, which I'm actually in the process of doing, and we just did some case studies on this. If I'm going to go buy a car today, I'm going to call the bank first, or I'm going to ask the dealership, what is a car note cost me? Right now, car notes are about 8%. So I'm going to charge my bank, when I borrow money from my bank to buy a car, I'm going to charge my bank 8%. So I'm going to pay myself back 8% annually. Okay. Because if I'm going to give it to someone else's bank, why would I not give it back to my bank? And rule number 3, always recycle and recapture your money, meaning be an honest banker. So here's what that means is when you take the $25,000 from that policy, you don't have to pay that loan back. You are in complete control. That $500 a month or $6,000 a year I'm repaying myself, I decided to do that. The insurance company doesn't dictate I do that. I'm in complete control. If I wanted to pay myself up back $100 a month and it goes over 20 years, I can do that. If I want to pay myself no dollars a month and pay myself back in a lump sum in 3 years, I can do that. If I want to never pay myself back, I never have to. Why? Because the insurance company, when they give us that money, they don't care. They know they're going to pay that money out to us at some point in the future anyways through the death benefit, because all we're doing is borrowing against that death benefit using the policy as collateral for that loan from the policy. But to do the infinite banking concept, be an honest banker, we do always want to recycle and recapture our money. So that's what I'm always going to recommend to you. But at the end of the day, you're in complete control about it. Fair enough. And if this works for a car, again, what else? Any of you in South Florida? How about boats? Any air pilots on here? Airplanes. I'm working with my cousin and uncle right now to use one of their policies to buy a new plane. I mean, any real estate investors on here, Joe, use this to start buying real estate, repairs, fix and flip, money that you need for the fix, things like that. So it's really endless, the ways that we can use this thing. All right. So next example, debts. This is fun. All right. So this is a real case study. This was with a chiropractor. This was about 10 years ago. But there's a reason I still use this case study to this day. And I'll show you in a second. All right. So this was a chiropractor and he made good money. Don't get me wrong. He made a lot of money, but he also found himself in a lot of third-party debt because a lot of human nature, it seems, the more money you make, the more money you end up spending. And especially if it's something new for somebody, a lot of times they go out there and they start buying a lot of things because they can afford the monthly payments, no problem, but they don't realize how that starts to really compound on top of each other. So in this case, this chiropractor had $478,000 in third-party debts. He had $5,700 a month going out, $69,000 a year to all these different banks. So we did the math, and if he was to continue on his plan that he was doing, it would take him 19 years without ever adding any more debt or purchases to it, 19 years just to pay off this existing third-party debt. So we said, okay, let us show you a better way to do this using the infinite banking concept and the money multiplier. So here's what that looks like. This chiropractor started a policy putting $25,000 a year into it. So when he put the $25,000 a year in year one, he had $14,863 available to pull out of that $25,000. Now, today, as I mentioned earlier, we're able to build policies a lot stronger for higher cash value. So today you put 25 grand in, I can get you access to 70, 80, pushing 90% of that initial 25,000 available to you immediately if we design it for higher cash like that. Now, it's not always appropriate. We're going to want to talk to you about your situation and your goals, but just know if you're looking to get access to more of the money you're putting in year one, just let me or Sal know and we'll build it appropriately for you. But the reason I still use this example, under promise, over deliver. Because if this is going to work as good as I'm going to show you right now with this old policy design with lower, imagine what it can do with our new updated policy designs. But let's get into this. All right. So what we do is he puts 25,000 in, we pull a little less than 15,000 back out. And then we use that money to pay off the Discover card. We pay off the Lowe's card and we pay down the Nordstrom card. So now he had $5,777,000 going to third-party debtors. We just eliminated 448 of that 5,777. Now let's make sure you guys are following what I taught you just a second ago. If we eliminate that 448 from Discover and Lowe's and Nordstrom down a little bit, what are we now? And we're no longer paying them 448 a month. What are we going to do with that 448 a month? What do you guys think? It's no longer going to Discover and Lowe's. Who is that for? What are we going to do with that for? Are we going to go blow it? Are we going to go buy more stuff? Are we going to just start saving it? What do you think?
Put it back in the policy.
Thank you. Thank you.
Pay myself first.
We're going to start paying it back to ourselves. Okay. So back to our bank instead of somebody else's bank. All right. So the way that we do this is we teach you to use what's called a segregated bank account. This is just a separate checking account that's used for tracking and accounting purposes and for recapturing and recycling our money for the infinite banking concept. So what that looks like is what we're going to do is we have the policy, we have the cash value in the policy. We take the money from the policy into the segregated account. Then we use the money from the segregated separate checking account to pay off the Discover and Lowe's. And then what we do is each month we start paying back into our segregated account $448 a month, whatever we just eliminated. All right. So we're going to start snowballing this. So by doing this, we have that $443.29 a month going to the third party still, and $448 a month going to our segregated account. So in the second year of this process, we have another $25,000 that goes into the policy. We have 16,500 now available of that 25. Remember, the first year 25 went in, we had 14. Now we have 25 going, and we have 16.5 available. You'll see every year it's just more and more and more. And we also have $5,300, the $448 a month over 12 months, $5,300 that we recaptured back to our banking system for a total of 22 grand in the second year that we can now use to tackle more debt. So buy Nordstrom, buy Wells Fargo, buy private loan, and we reduce the balance on the BMW. So now we have 3,800 going to third-party debtors and $1,900 a month we're recapturing back to our bank. Year 3, same thing. 25 available, 23 in recaptured payments, a total of 48,000 to tackle more debt. Goodbye BMW, goodbye West Marine, and reduction of the condo. So now we have 2,100 going to other people, 3,600 going back to our banking system. Now let's make sure you're following so far. Again, this is a marathon, so let's make sure we're following. How much have we put into this thing so far over the first 3 years? $75,000. How much have we pulled out of the policy to use to tackle debt? $55,000. So how much do we have left in our policy? If we put 75 in, we pulled 55 out, we're using to tackle debt. How much do we have left in the policy?
Jeopardy question.
Yeah, I mean, you would think $20,000, right? But here's how this works. We actually have $75,000 still in there. And what happens is when we put that 75,000 in and we pull the 55,000 out to use it, in this case, to pay off debt, we don't actually withdraw money from our policy. Just like the example earlier with the bank and buying a car, we're using our policy as collateral, that death benefit as collateral, and the insurance company's giving us a loan from their general account. And what that does is that allows our money to sit within the policy, compounding uninterrupted tax-free for the rest of our lives, even when we're simultaneously pulling all that money out to use it for other things. In this case, paying off debt. In the next example, for growing wealth through investing. All right, so just want to make sure you guys are following so far. It sounds like everybody kind of got that. All right, so just to finish this off, fourth year, 25 goes in. We now have 26.3 in the recaptured payments. All right, year 5, 25 goes in. Okay, now year 6, this is important. Pay attention here. Year 6, this is important because in year 6, in his policy that we designed for him, in year 6, he no longer could put $25,000 into that policy. He was only allowed to deposit $10,000 into that policy starting in year 6 moving forward. Now, why did that happen? Because of IRS rules and regulations, something called the MEC rules and the 7702 rules. And so what happens in that, and that will happen with you all as well, with your new policies. However, now it typically happens in year 11. So whatever amount we can put into up usually through year 10, but then in year 11, typically that amount's going to drop down. So what happens there? What happens if you're like, well, you know what? I love this system. I don't want to put less money into it. I want to put more money into this thing. Well, you can't put more money in that existing policy, but what can you do? Well, you can open up additional policies. So this is where you start stacking policies to grow your banking system. And where that's so powerful is being able to really put more and more and more, run more and more through the system, get more and more of your money compounding and grow for the future. So right now I'm working on my 4th policy. My mentor, Chris, is working on his 12th. My other mentor, Brent, now has 22 or 23 of these policies. So you just keep stacking them as you grow financially. But back to the chiropractor. So his first
question.
policy.
Can I just ask a question while
Absolutely.
I have this in my head? Okay, but the older you get, isn't it harder? Isn't it more expensive to get the policy?
So the cost of insurance is level throughout your lifetime. So when I start a policy at 40, my cost of insurance will be the same today as when I'm 90 years old. So where the nice part about that is as my money compounds, that's why I have more and more available cash value because of the level cost of insurance. Now, if you're starting a policy at 70 years old, absolutely. Your cost of insurance is higher. But because we build these policies for banking purposes, you're going to have a lower death benefit, but your cash value available and cash value growth is going to be very similar to my policy at 40. So it might be a little bit less, but it's still going to have high cash value available today. And you're going to have uninterrupted compounding growth throughout the rest of your life. So if you're 65 years old, I mean, how old are you going to live? You know, let's say you make it to 90, 95. That's another 25 to 30 years. Your money's sitting there compounding uninterrupted. And just because that death benefit starts smaller today, over the next 25 to 30 years, it's also going to grow for you. So you might have a little bit lower death benefit, but all of this is still going to be 100% relevant for you. Does that make sense?
There are other ways to get around that as well. Obviously, Steve, I don't want to take up too much time on that, but Lori, so a person that's 70 might have a 30-year-old, 35-year-old child or son or daughter, and we would use their body. We would use their body as an acting bank and stand-in bank. And so that's how we get around that. So it works either way, no matter how old you are, because age has.
But
really
the death benefit goes to them then.
Yeah, that's a different discussion. But if you're looking at
no, that's not correct. That's not correct.
Right,
so the death benefit. So if you own the policy, you dictate where the death benefit goes.
Right. Who gets
It would just be based on when they pass, or as we say, graduate.
Okay.
When they pass, that's when that death benefit would be paid out. But the beneficiary, if you own the policy, you determine that.
And I want to say something, Stephen, very quick. Somebody said, well, maybe why do we have to stop or put less money in, right? Why can't we continue to fund our bank to this maximum amount or put as much in as we can? Well, you may not know this, but there was a time where you were able to put in as much money as you wanted into this. And this was before banking got regulated or deregulated and merged in with insurance. That what happened was people were moving all of their money out of their bank, out of the traditional banks, and now realizing how great this thing is to have. And so the banking industry really fought very hard and try to put a stop on that. And that's where some of these limitations have come in. But prior to that, this was like the best kept secret ever, really.
Yeah. And even today, I mean, yeah, to your point, I mean, John, I just looked over at the chat, you put 70,000, you can, and I'll show you an example of this in just a second. I'm actually glad you asked that. We can build it where if you want to put 70 grand in, up front, but maybe you only want to commit to 5, 6, 7 grand a year in savings moving forward, we can definitely build it that way. So you can put a huge amount in up front. We call it a dump in. And then put a much smaller amount in annually moving forward, something more affordable. So we can definitely do that. And those are actually really good looking policies. And I'll show you an example of that in just a second. But yeah, I love it. So that's why all that happens. So did that answer your question though? Is that good? Okay, perfect. All right.
Does the policy max out the amount that I can put in? Like you were saying, if I want to put the 70 in up front, is that the maximum I can put in is 70?
No. You can, well, it's as long as we design it up front the right way, we can design it with almost any amount you want going into it. So don't worry about that. And we could talk more on like a one-on-one basis of what that looks like for sure. But yeah, we can, we're very flexible with that for sure.
Yeah, it's almost like buying a car with a turbo. Do you want a 2.0 or a 2.5, right? So if you get the 2.0, you're going to have to live with the 2.0 because that's how much headroom, that's how much maximum capacity you have. So knowing what the 2.5 might do or might be, a person might say, you know what, I might hit the 2.5, right? I might be able to fund it that high. So let's look at that 2.5. If I don't make it, I don't make it.
Yeah, and then once you max that one out, then you start additional policies, just like this chiropractor right here. So he maxed this one out. He was only able to put 10,000 in. Although it's pretty cool. Look at that. When he puts 10 in the 6th year, he has 13,000 available. That's a 30% cash on cash return that year, tax free. So not bad. And then he started a second policy to continue growing his banking system, putting 25 grand in. Now you do start fresh with the new policy. So he's back down to 15,000 available, but it doesn't take long to get those 30% returns, 6 years. So just to give you an example of that. So now in the 6th year of this thing, we're able to pay off all third-party debt. We have no money interest that we're bleeding out to other people's banks. Now he has $5,777 a month, not going to there. And like I said before, what are we going to now do that $5,777? We're going to continue to pay that back to our banking system, put it back into the policy. And then what are we going to do with it from there? Well, that's where the next part comes in, because once your debts are gone, now we can have fun. Now we can talk about becoming the millionaire and doing some investing with it. So what I just showed you right there, how we created that plan for that chiropractor, we will do that for all of you as well, completely free of charge. So what our company does is not only does the money multiplier strategize with you to design and create the perfect policy for your situation, but we help you with the approval process and dealing with the insurance company to go through the application. And then once you start the policy, we have what's called our mapping implementation team that's going to immediately work with you to teach you how to use this thing for banking principles, banking purposes. So if you have debt, you'll want to start getting that debt together. Principal balances, monthly payments, interest rates, all of that. And we're going to create this debt map for you using your new policy, your new banking policy, to snowball and pay off that debt, just like we did with that chiropractor. And if anything ever changes, if you fall behind, we're right there to meet with you and update things. Our implementation servicing team actually reaches out to you every 3 to 4 months just to check on you. And this is a lifetime service. You'll never pay a dime for any of it. So I just want everyone to know, we don't just create this and get you excited and leave you on your own. We're right there to support you for years and years and years to come, completely free of charge. So we will do that for every single one of you as well. And I like to call it a financial GPS. Where are you today? Where do you want to go? Let's get you there in the quickest way possible, using strategies like the infinite banking concept. So we'll do a strategy call with anybody that wants to do that. I'll show you how to schedule that call in just a second, but I wanted to get into kind of the fun part when it comes to becoming a millionaire. So here's a couple questions. What if you don't have any bad debt right now? Or what if you don't need to buy a car? Can you still do privatized banking? Should you still become your own banker? And I say, oh yeah, because that's really where the fun begins, and where you can start building, wealth and really creating a legacy for you and your family. So what does that look like? Well, for me, this is all stuff that I'm in. Crypto, not right now, but these are some of the other things that I'm doing and stuff that we teach. So active real estate investing, passive real estate investing, things like private funds. I think there's a lot of opportunity in some commercial real estate right now, especially like I've seen some incredible deals on self-storage properties and mobile home parks. Business owners investing in startups, investing in other types of businesses and IP. I think there are some opportunities in the stock market, just not right at the moment. Just if anybody's wondering, I'm completely out of the stock market and completely out of the crypto market at this time. I do think there's some money in note investing. I just got involved with some equipment flipping. And so just some different ways that we can create wealth. But guess what? Everything that I'm doing on this front is either coming from a self-directed retirement account or from one of my banking policies. Why? Because my self-directed retirement accounts allow me to take advantage of tax laws and eliminate taxes, and my banking policies, by investing through those, it allows me to have uninterrupted compounding tax-free growth within the policy while I'm simultaneously doing all of this stuff as well. And so once you start compounding and multiplying what you're already doing, you're able to generate and create wealth that much faster. Not to mention what that legacy looks like for my son. And I'll talk a little bit more about that in a second. So 2 laws for creating wealth. If you get nothing else out today, please follow these 2 laws moving forward. Number 1, compounding interest. Albert Einstein coined the phrase. He called it the 8th wonder of the world. Albert Einstein, he said, those who understand it use it, those who don't pay it. Law number 2, money movement. So money sitting still in something like a traditional savings account or a business account, it's losing money. Money in motion is always making more money. So you always want to have your money moving and flowing to create and generate more wealth. And so why I love these policies and the infinite banking concept is it allows us to use both of these laws simultaneously at the exact same time. And I've never found anything more powerful for generating wealth than that right there. So let's look at a quick example of what this looks like on the passive side. So if any of you are private money lenders or thinking about doing it, let's look what that looks like using a policy. So this is a policy illustration. This was a policy that went in force. This is an actual client of mine. They started this policy last year. So this was a real estate investor. She's in Oregon State. And she wanted to put $150,000 in the first year, and she wanted to put $50,000 a year in after that. Now you'll see in the 11th year how that amount drops to 17.5, like I was saying in this example before. All right. So what does this look like? Over here on the right side, you can see the net cash value and the increase in net cash value. So as she puts money, deposits money into this policy, that's how her banking system, how her policy grows. So you can see the first year she puts 150 in, she has 132,000 available to use. Starting in the third year, she puts 50 in, she now can pull out more than 50,000. So starting in the third year of this thing, every single year she deposits money into her banking system, she can now pull more than those dollars back out. And you can see over here, it just becomes exponentially stronger and stronger and stronger every year for the rest of her life. Just to give you an example, look at the very bottom of this. When she's 55 years old, the 15th year of this policy, she puts $17,500 into it. Can you see how much that policy grows by that year? $54,136, meaning when she makes her $17,000 deposit, the next day she can borrow back out $54,000 from that policy. What's the return on that? I don't even know. Probably 400%.
Thousands.
So it's pretty amazing. I mean, so there's just an example, all right? So here we go. So how does this work with private money lending? Well, I do a lot of private money loans through Private Money Club. I see a lot on there. Very common right now is 12% annual interest. All right. So let's just say that she started this policy last year. She's doing some active real estate. And then in the 8th year, she wants to do a private money loan. So in the 8th year, she deposits $48,593 into her banking system. Well, her policy grows, her bank grows by $66,720 when she does that. So that is a growth of $18,000 or 37% cash on cash tax-free return within the policy. Now she goes and she identifies a private money loan at 12%. So she lends the money from the policy at 12% and earns 12% on her money by doing the loan. Her money grew within her policy 37% that year. To take the money out of the policy, we do pay the insurance company 5% annual interest when she pulls the money out. So if I add up all of this, she made 44% on her money that year doing a private money loan. So let me ask you guys this. We didn't do anything different here. If I was to go do that same private money loan, but I was to borrow the money from my Wells Fargo account, I would make 12% and I would make nothing because I pulled the money from the bank account, right? So I would make 12%. So by making one change, putting my money into my own banking system instead of somebody else's banking system first, in the 8th year of this, I was able to make 44% on my money instead of 12%.
Well, actually,
what would you rather do? We didn't do anything harder. We didn't take on any more risk. We didn't work any longer. We just changed one thing, where our money went first. Does that make sense?
Actually, Stephen, you don't make 12%. You make 7% net.
If you
because you got 12% that you're getting, right? And then you're paying 5%. So you're really netting 7 in that case, not 12.
Well, in a private money loan, we would make the 12%. So that's just flat off the top. The 5% would be if we're borrowing from our own banking system. So that's why I netted that out. So we would have made 49%, but we do pay the insurance company. So it drops it to 44.
There you go. That's it. Exactly.
So it's pretty straightforward. I mean, it's but you got to start, right? Again, you got to crawl before you walk. You got to walk before you run. But once you run, you start doing marathons like this all day long. So here's another one. This was a younger guy, 38 years old. This was a policy we did last year. In this case, he had a big lump sum from a couple wholesale deals he did, but he was still new to real estate and he wasn't confident on putting large sums in. So he said, you know what? I'm confident putting $500 a month in, which is $6,000 a year. But he had that extra lump sum up front. So that's how we designed the policy. He dumped 50 grand in up front, and then he started putting $500 a month in. Perfectly okay. In the first year of that policy, he put 59,000 in. He had almost 52,000 available. Again, very high cash value. In the second year of this thing, he deposits 5,900. He has 7,100 available, 21% cash on cash return.